Is this a global new bull market in equity? To answer that, we need first to focus on the weekly charts of the US dollar index on a long period of time, about 3 years. First of all, we noticed that since the beginning of 2015, we are in a flat range. Recently, in 2018, dollar index has been moving up and has been going through the cloud here, giving a kind of a bullish signal. At the same time, we need to notice what happened on the top part of the charts. Here in red dotted line is the Bloomberg Commodity Index, and we see that in this last rise of the US dollar, that corresponds also to a kind of a pause or a little decline of US dollar of commodity indices. Usually commodities move in the opposite direction of the US dollar, but right now it hit support and seems to make a pause. If we just look a little bit more in detail and closer, we notice that on the new high of the US dollar index, higher high, we had, as a matter of fact, on the momentum side, on the down part of the chart here, a kind of a bearish divergence. That means usually a pause, and that's exactly what happened in the last 3 weeks. The dollar is pausing, has been pulling back a little bit, but it's still in an uptrend, and we see that the correlation between the US dollar index and the spread, so the differences between 10 years US rates and the 10-year German rates, is also making a pause. So we see between the orange line and the US dollar, there is a kind of a nice correlation. And we see also with these closer looks that the Bloomberg Commodity Index, at the time where everybody thought that commodities were going down the drain during August and the dollar was rising to a new high, we see that basically we are at the same levels at the end of August. So in fact, the dollar rise has been stopped, and that means also that other currencies against the dollar have stopped declining. And this decline of other currencies, and together with the decline of commodities, has of course been materialized by the performance of emerging markets. As we all know, during already July, here we see the relative strength of emerging market and versus the S&P 500 coming down. We see since the beginning of the year, indeed, but accelerating in the last 3 months, a nice downtrend for emerging market, which has been making even in August a lower low. Recently, in the last 2 weeks, it seems to rebound a little bit and test the trend line, which is descending and joining the high. That probably suggests a pause for emerging markets, but it doesn't suggest at all yet a full rebound and a few new bull market for emerging markets. Let's see what happened in other areas of the world. Europe, for example. Well, nothing happened there almost on a weekly basis. As we see, we just had, during the decline, the new low of emerging market, also a small decline from the top of the range to the bottom of the range for Euro stocks. We still see the underperformance of Europe versus the US, with the ratio of the Stocks 50 versus the S&P 500 in the black dotted line, which is coming down, but just now in the last week or last 2 weeks, pausing or eventually stopping its decline. And we see that the dollar was going up, that means the euro was going down, and right now there is just a little pause, rebound of the euro. That's what we saw with the US dollar index pausing and pulling back down a little bit. So here we are very in a neutral area. We need really to notice 2 things. Number one, that the volatility has decreased with the Bollinger Bands, the red lines up and lower here on a weekly basis, getting narrower. Okay, that means one day when it will break out, either up or down, we need to be very attentive to what's going to happen, because then the subsequent move is going to be strong. Currently, it is relatively difficult to suggest that it will move rather down than up. For one reason is that, as you see, you are coming from lows in the 2900 area, and we are now at 35, and we also had for all of this first 8 months of 2018 a kind of a correction which has lasted for kind of a long time. So the bulls still have the benefit of the doubt, even though in the last 2 months there has not been a clear bullish sign to confirm the upside yet. The other area is Japan, and of course we know that both the Bank of Japan and the ECB are also having a monetary policy which is a little bit different from the US Fed right now. And we see that here that the Nikkei also is in a trading range, a little bit more positive than Europe, as it is closer to the resistance level or the upper Bollinger Bands that we are going to monitor very carefully. Usually, the Nikkei is rising when the yen is getting weaker, and that's the orange line, which had been declining slowly, but a bit too slowly to my taste. And frankly, we see that the underperformance of the Nikkei versus the S&P 500 has only stopped and really is not yet in an uptrend. So Europe and Japan, if you wish, are really following the US. They are not outperforming, even though a lot of people agree that it is good value and less expensive than the US market. So what has happened during August? In August, we can see that there was a move from defensive sectors toward defensive sector out of cyclicals. And that's the black line, the ratio of cyclicals divided by defensive. That has come down, showing the underperformance of cyclical, except in the last 2 weeks. It has reached a bottom at around the 20th of August, and then has been able to break above its descending trend line and trying to make a higher high before the previous one. And that rise of or comeback of the cyclicals outperformance come at the same time where everybody in the news knows that the S&P 500 has made a higher high above the 2872 levels of January at currently 2896 or 97. That's one aspect. The second aspect is with the black line here, which is showing the 10-year US yield, which is now stopping its decline and trying to rebound a little bit. We might have, together with the sector from the banks or the financial sectors, a breakout which is materializing slowly, a bit too slowly, but it's materializing at least. And so the financial sector is going to help also the S&P 500 try to rise, as well as something which is coming back after 2 months almost of underperformance. As we see here, the underperformance of the technology is being clear here by the NASDAQ 100 large cap has been underperforming the S&P from the beginning of July. And now it's starting to break up again, breaking its downtrend. That means it stopped underperforming, it rise a little bit again, and we have here a very nice, classical, simple signal, in the sense that in the last week we had a break up with a gap up, and it is also a so-called ascending triangle. Ascending triangle has a target which is situated around 78.54, so a few more percent upwards. We see that the momentum, which was relatively quiet and not flat but overbought, is picking up again, and that's of course, is more obviously seen on the daily charts, where momentum has been moving up since the 20th of August, and that should be followed by the MACD as well. We see here the breakout of this triangle on a more focused basis, and we see also among the NASDAQ, not only the FANG, but the semiconductors index has been stopping its move down and rising nicely and about to break above its former high in the beginning of August. So kind of a lot of good news with one caveat, and this is in red here. The volatility of the NASDAQ is not really making lower lows, while in the last 2 weeks we are breaking up. So there are still some people which are a little bit nervous. Quid of our long-term scenario? You remember in the beginning of April we draw that red lines, which we have a little bit updated now, and we are basically waiting for a kind of a pullback. This pullback might be delayed a little bit. What type of pullback is going to be? 10% maybe, and that would correspond to the normal seasonality. We are still in August. The pullback could take place in September or maybe late October, but probably more likely late September. Currently, we are just looking at a break up, a gap up, and that defines very nicely the parameters. The gap itself is 28.75 to 28.85. That tells us that as long as we remain above 28.72, which is the January high, there is no problem, but we are not far from it, and we know that a reversal below it would reopen the so-called 10% correction that we are expecting towards the end of September. As long as we stay above 28.50, 28.75, we need to accept the fact that the rise can still extend toward 29.50 or 29.85. And that's going to be really a tough ride, because on one hand, all the market looks bullish, but the market will probably be around these levels kind of overextended. So the next month is going to be quite interesting, as we are going to see if there was or there wasn't a risk in September, as it usually happens. Thank you for watching.